All right, let's jump right into this explainer. Since way back in 1926, the U.S. stock market has delivered an average annual return of roughly 10% a year. Think about that for a second. Across world wars, Great Depressions, and crashes that literally felt like the end of the financial world as we know it, that 10% number, it's steadily held its ground. But here is the ultimate paradox. Despite having this incredible, historically proven engine of wealth right at our fingertips, most people who invest in the stock market still don't actually get rich from it. So why is that? Well, it's not because the market failed them. Actually, it's because they failed the market.
To really wrap our heads around why this happens, we need to talk about a massive, almost impossible number, 29%. The story behind it is just wild. From 1977 all the way to 1990, a fund manager named Peter Lynch ran Fidelity's Magellan Fund, and during that stretch, he delivered an average annual return of roughly 29%. I mean, that is quite literally one of the greatest track records in the entire history of investing. If you had simply put your money into his fund and just walked away, you would have gotten spectacularly rich.
But here is exactly where our paradox shows up. Fidelity actually went back and looked at their own internal research for this exact period. And the results? They are absolutely staggering. While the fund itself was up 29% annually, the average investor in that very same fund actually lost money. Just let that sink in for a second. They didn't just underperform the market. They outright lost money during one of the most successful investing runs of all time.
Which obviously begs the question, right? How in the world do you lose money in a wildly winning fund? Well, it all comes down to this deeply destructive psychological cycle. Investors saw the fund having these amazing years, so they piled their money in, effectively chasing performance that had already happened. Then, when the fund inevitably hit a normal bad year, they panicked. They completely freaked out and pulled their money out, locking in their losses right before the fund bounced back. So they bought high, they sold low, and they did it over and over again, basically turning a brilliant investment into a money-losing trap.
This behavior isn't because people are foolish. It's driven by a literal psychological glitch in our brains called loss aversion. Simply put, as human beings, we feel the pain of losing money roughly twice as intensely as the pleasure of gaining that exact same amount. Look, if you've ever felt totally sick to your stomach watching your portfolio drop, this validates exactly what you were feeling. To our brains, a 10% drop feels like a total catastrophe. And that hugely disproportionate emotional reaction, that's exactly what pushes us toward making terrible financial decisions at exactly the wrong time.
So, fear and greed are basically sitting on opposite ends of a seesaw for every single decision you make in the market. Greed steps in and convinces you to buy at the absolute peak because, let's face it, you're terrified of missing out on the gains your friends are getting. But once fear takes over the very second prices fall, it convinces you to sell everything just to stop the pain. And sadly, that is the exact moment you permanently lock in those losses.
And honestly, this human flaw leads to a bizarre, almost darkly funny realization. Internal research at Fidelity once found that some of their absolute best-performing individual accounts belonged to investors who had died. Yeah, dead people. And the second best-performing accounts, those belong to people who completely forgot they even owned the account at all. Because they weren't obsessively watching the market, nobody panicked, nobody sold at the bottom. The money just sat there, compounding in silence, completely protected from its own owner.
Okay, so if our own human psychology basically ruins everything, what actually works? Well, it's time to shift gears and look at the hidden 5-ingredient formula used by history's greatest investors. It's mathematically devastating, but honestly, beautifully boring.
So here are the 5 ingredients: time, consistency, broad quality, dividends, and patience. Let's start right at the top with the first one, time. Compounding needs decades to do its real heavy lifting. The growth curve eventually bends upward in a way that looks almost unfair, but you absolutely have to wait for it. Take Warren Buffett, for example. He is one of the richest people alive, yet he earned the vast majority of his net worth after his 60th birthday. Not because he suddenly got way smarter in his 60s, but because compounding simply requires time.
The second ingredient is consistency, and you get there through a method called dollar-cost averaging. Now, this just means investing a fixed amount of money on a regular, set schedule and completely ignoring whether the market is up or down that day. This is a total game changer because it completely removes the impossible pressure of trying to perfectly time the market. You just automate the whole process and let it run in the background.
Of course, the really crucial point here is what you should consistently buy, which brings us to ingredient number 3, owning broad quality. Back in 1976, a guy named Bogle launched the very first index fund available to everyday people, and Wall Street
absolutely mocked it. They called it Bogle's folly, claiming that just owning the entire market guaranteed mediocrity. But reality tells a very different story. By keeping fees incredibly low and owning the whole market rather than making narrow, risky bets, index funds have consistently outperformed the vast majority of actively managed funds over long time horizons. Now, ingredient number 4. I know, it sounds like a boring technicality, but seriously, do not ignore this one. Dividends. Roughly 40% of the stock market's long-term total return comes purely from reinvesting your dividends so they can compound right alongside the price growth. Think about that. If you take those dividends out as cash to spend, you are leaving an absolutely massive portion of the market's historical return right on the table.
And this brings us to the 5th, and undoubtedly the hardest ingredient of them all. Patience, without exception. Look, it's really easy to follow a neat little formula when your portfolio is going up and to the right. It is entirely different when the market is crashing and your emotions are screaming at you to sell everything. So, let's put this formula through the ultimate stress test by looking at how it actually survives history's greatest market panics.
Just think back over the last few decades. We've got 3 totally distinct crises. In 2000, the dot-com bubble burst, absolutely devastating tech stocks. Fast forward to 2008, the financial crisis wiped out a massive chunk of global market value. And then in 2020, COVID triggered one of the fastest crashes we've literally ever seen. 3 different decades, 3 completely different crises where it legitimately felt like the world was ending. But the lesson? It's identical every single time. The market has never failed to recover. The investors who panicked at the bottom locked in their losses for sure, but the ones who patiently held on, they rode the wave right back up to new all-time highs. So what should we all take away from this explainer today? Well, here are the actionable principles you can use right now. Start early, because time is the one vital thing compounding simply cannot work without. Invest consistently and completely ignore the daily news headlines. Favor broad diversification over highly concentrated bets. Reinvest the dividends the market pays you. And most importantly, build a plan you can actually stick to. You see, the perfect investing plan isn't the most mathematically complex one. It's simply the one you don't abandon when the panic hits. Which leaves us with this final, provocative thought to chew on. When it's all said and done, will you be the last one in the room? The stock market doesn't demand genius from the people who get rich in it. It doesn't reward the smartest investor, the one with the best insider tip, or the one trying to perfectly time the top. No. It rewards the one who simply stays in the room, decades later, long after almost everyone else has packed up and left in a panic. Thanks so much for joining me for this explainer, and I really hope it changes the way you look at your own investing journey.